Welcome, everyone, and thank you so much for joining us. My name is David Murphy, the founder and CEO of TechFire, and I'm so delighted to welcome everyone to the program today. We just have a wonderful panel today, and couldn't be more excited about this topic. I know it's one that's, you think of the phrase, show me the money. It's one where things are actually still hopeful despite what the broader economic trends may be right now in the world. There is a lot of venture capital out there. Obviously, due to the nature of VC funds, the money was already raised, and companies are going to digital. They weren't even in the digital world before, so there's so much happening here. It's an area where there's still a lot of good news, and hopefully good companies to continue to be built even amidst the broader unique factors in 2020. So couldn't be more excited about panelists and experts here today, and we'll be getting to them shortly. But for those of you who are joining us for the first time, I know I saw a lot of familiar faces on the RSVP list. It's great to have all of you back. I wish I could see you in person during our normal pre-event reception, but thank you for being here. And a particular thanks too to everyone who's joining us for the first time. It was fantastic to see RSVPs coming in from England, India, South Africa, and everywhere from Honolulu to Texas, in addition to our usual Los Angeles crowd where we were founded in 2013. And, that's one of the, again, bright spots here in 2020 that we can all come together all around the world to share knowledge and help each other along. And really, that's the genesis of TechFire. We were founded back in 2013 because at that point, I didn't see enough high caliber speakers coming through town here in LA and the tech ecosystem that, well, gosh, to date myself, way back in the day, I'd seen, big exits like MySpace and, such, but it had started to grow again, and Snapchat and, TikTok's U.S. headquarters. Oh my God, so much has happened since then. But we've been so excited to be a part of the growth here, and then expand to the Bay Area, and now be able to welcome all of you from around the world here today to join us via Zoom. So it's great to have you here, and just want to thank everyone for joining us. And a huge thanks to again all of our speakers. You'll be hearing from them shortly. But before we get started, I just want to give a huge thank you to Brisbois for sponsoring. You'll be hearing from one of their partners, Michael Platner, who'll be moderating shortly. But I just want to give you a quick overview of the firm. They are one of the largest law firms in the U.S. With a presence all across the country, and they have specialists in more than 40 different areas of the legal profession. I just want to emphasize how important it is to have the right legal partner in your startup or your growth company. I have seen what happens to folks when they, try to use their uncle's divorce attorney or something to put together their founding documents, and then, well, it's all built on a shim-sham foundation. Everything comes crashing down. I mean, the business world is hard enough without having the right foundation, and it's just so important whether you're just starting out or whether you're growing and you need a company legal partner that like Brisbois is a lot of experience defending corporate America, can help you as challenges inevitably do arise as you grow. So I really encourage you to check out their website. It's lewisbrisbois.com. That's Lewis, BRISBOIS.com, where you can learn more about the firm. But you'll see Michael in action here, so I won't say any more right now, except deepest thanks indeed to Jennifer and to Michael for helping us plan this event and get going so quickly. I'm just so grateful. They've been a true pleasure to work with. And speaking of Michael, I want to introduce him first. He'll be moderating today. He is indeed not just a partner with the firm, but he is actually the chair of the corporate practice, as well as co-chair of the securities and corporate finance practice. So he has both the corporate side covered and the VC side covered. But actually, to borrow a term from a certain VC here in Los Angeles, he has been on both sides of the table himself. He's been an entrepreneur. He's sold company for more than $100 million. Computer Associates, been CEO of another company. Maybe he'll tell us some stories along the way here, intermixed lessons learned along the way. But you know, you don't always find that in lawyers, folks who can walk in your shoes and really understand how deals happen and sort of what the human factors are and the real realities beyond what they teach in law school. So that said, he is, of course, very far removed from law school, with a lot of legal experience. You know, doing this for 37 years, I think you said. You know, corporate law, M&A, everything in between. So, Michael, we're so grateful to have you moderating here, and what great speakers we have. We're so delighted to have Neal Bhadkamkar, general partner with Bold Capital Partners. You know, many years ago in college, I had the pleasure of interning for one of Peter Diamandis' other ventures, Space Adventures. If you know, get too stressed out from your startup and look for a great vacation after this pandemic is over, check them out. They'll book you a trip to the International Space Station. But if you're back here on Earth and trying to be bold with your startups, well, Bold Capital is here with about 250 million assets under management. And Neal is someone who has a wealth of experience, joining us today from the Bay Area, San Francisco Bay Area. You know, he at one point had been head of commercialization for Microsoft co-founder Paul Allen's Silicon Valley Incubator, and he was co-founder and general partner of Monitor Ventures as well. So truly an honor to have you join us, Neal. Thank you so much. And joining us more locally here from the Los Angeles area, we're so delighted to have Dave Csepel, chairman of the Pasadena Angels, which is just a wonderful group. You know, you learn about those in the LA ecosystem, often bump into folks in the Pasadena Angels. We've been privileged to have a number of folks join us across our 55 past events, and going to be even more excited, Dave, to have the chairman now joining us here to speak. And you know, I think being an angel on the front lines is really interesting, particularly now when you can't, you know, necessarily meet your potential investees. Very interested to hear your stories about what it's like these days. But just a little background: Pasadena Angels has invested more than 75 million, 195 companies. They have both their own fund and individual angels who invest. And Dave himself is a serial entrepreneur. He's had a fascinating background, and also has worked in the entertainment world as well. So truly looking forward to a great panel here, and thanks to all of them. And again, thank you so much, Michael and Jennifer and the firm for sponsoring today's program. And I'm going to turn things over to you, Michael.
Thanks, David. And thanks for all your hard work in putting this together. I know we were hoping we'd be sitting in Los Angeles overlooking Silicon Beach today doing this, and instead here we are on Zoom like the rest of the world. But it's a great pleasure to be here with Neal and Dave. And as you said, I consider myself no longer just a closet entrepreneur as well. I've represented hundreds and hundreds of entrepreneurs, as well as their investors and entrepreneurial investors, and now I'm happy to be able to say I'm one myself, and also a part of a Florida group called the New World Angels, which is a little bit of an analog to Dave's Pasadena Angels on the East Coast. So I feel like I'm here with family, and I think like we have a really important mission to accomplish in the next less than an hour. And that is to pick the brains of Neal and Dave, and to share with our audience what it's like to be a venture capitalist coming through a pandemic. Probably haven't been a lot of workshops online with this subject in the past. So I feel like we're breaking new ground, and we've got a lot to talk about. So I want to kick it right off and ask the first obvious question, because it'll be helpful for our audience to know what the state of mind is of at least these two venture investors. Guys, do you think that and I'll start with Dave and then go to Neal, do you think that your portfolio of investments has increased, or even, or down in value as a result of the pandemic?
Okay, I'll go briefly,
Dave?
and then I'm interested to hear what Neal is thinking. You know, we've invested in a lot of these companies because we believe in where they're going to be in 5 to 10 years. What COVID has done to some of these companies, not all of these companies, has acted as an accelerant. So bringing in these companies, that 5 to 10 year timeline is now, even pushed up maybe to 2 to 4 years. And some companies have had to react to that accordingly, hiring positions, getting their sales teams more, filled up more, getting their customer service element tightened up a bit more as the volume has picked up. And I'll give you an example of one or two of these companies that we've invested in that has seen this uptick. And I also want to say, as angel investors, and I'm sure Neal will agree as a big VC investor, our help and our assistance and our need as a partner to these companies has never been more valuable. We need to open up our Rolodex, find them good financial folks to help organize their businesses. Also open up our Rolodexes to expand their marketing and their presence overall. So to answer your question, undoubtedly some businesses have been affected to the negative. You can guess there are anything hotel related, things like that's kind of a negative effect where you have to kind of be in person and rely on in-person bookings to grow. However, some businesses such as at-home testing, diagnostic, medical testing, and so forth, one of our companies called My Lab Box, located here in Los Angeles, has seen a terrific benefit towards the COVID element, as more people are afraid to go into their doctor's offices and hospitals to get routine testing, whether it be for the flu or testosterone levels and so forth. A little background: My Lab Box started as a testing group for sexually transmitted diseases. So whether it was gonorrhea or clap or what have you, it was really geared towards millennials comfortable with that receiving things at home for privacy's sake. I think 23andMe really kicked it off, and these guys are just running through the hole that 23andMe got. So with testing coming back and you're able to prick yourself with a finger or a little saliva, you're able to send that back and get instant lab results. I think all of us have been accustomed to seeing our local doctor, our physician for those tests, but now that at-home testing has really taken off. Matter of fact, I wrote down here that Colorama information has reported that an increase of 1,500% at-home medical testing and diagnostics has taken place over the past year. So My Lab Box is a beneficiary of that. And when we invested in at about a $6 million valuation, that revenue was at about $40,000 a month. Now they're at about $350,000 a month, and they're looking at their Series A and raising money at about a $20 million valuation. So again, very much on the small scale when compared to Neal's companies, but you can see these little seeds starting to burst up and grow. And then now I want to hear from Neal. What are you seeing? What are you thinking?
Yeah, Neal, of course, with you, I know you've got at least two funds that, why don't you talk about the size of your two funds? And I know you've got over 40 portfolio investments currently, and you're starting a third fund to do for dry powder and secondary investments. So answer the first question. Do you think you're even, down, or ahead as a result of the pandemic, and then go into some of your perspectives on why?
Certainly. I think so far, I would have to say that we're actually ahead. Now, not ahead because of the pandemic, but I would say ahead despite the pandemic, in the sense that because I think we've ended up with over half our portfolio in the healthcare space, broadly defined, a lot of those companies have seen a tailwind from COVID, and that's actually been very beneficial. The rest of our portfolio is really scattered between industrial productivity, which is applications that large enterprises need for reducing their costs and improving productivity, ranging all the way from robotics to AR to industrial IoT. Then we have companies in the food and ag space. We have companies in the transportation ecosystem, shelter, education, and security. So I think because of our portfolio selection, the companies are all creating products or services that actually help their customers reduce costs or improve their own outcomes. And so even though the pandemic has had an impact on certain kinds of companies, and I'll give you an example, in other places, it's actually created a boost. So the companies that have been most impacted are the ones that were selling, let's say, to industrial companies like the GEs or the companies making large white goods and things. As they had to shut down their factories, their demand for new products and services necessarily took a hit. But as an example, in the supply chain space, companies that are buying supply chain software but happen to be in the pharmaceutical space have actually increased their demand, because all of a sudden they're seeing huge, especially those companies in the vaccine business or diagnostics, are seeing huge increases in what they need to do. And so the urgency of having good supply chain software in those kinds of situations has actually gone up. So as an example, we have a company that creates great supply chain visibility software. For one part of their business, it slowed down dramatically when they were dealing with the large white goods companies. The other part of their business, which was targeted towards pharmaceutical companies, saw a huge gain. So I think we have been fortunate so far. The other test of all this is, of course, to what extent companies were able to complete financings. That's kind of where the rubber hits the road. And coming into the pandemic, there was obviously a lot of concern because no one knew how long the pandemic was going to last. No one knew how severe it was going to be. And no one knew whether investors would dry up entirely, as they had done, for example, in 2008, 2009. So I think there was enormous uncertainty around March, and March and April, did have a lot of replanning by pretty much every portfolio company as they were trying to assess what the demand picture would look like and what the investment picture would look like. But when we entered the pandemic, we had 7 companies that were in various stages of fundraising, ranging from, had term sheets to we're just starting to talk to investors. We were obviously concerned about how those would play out. Now, as it turns out, 5 of those have completed financings at valuations that have not had any impact from COVID. And the 2 remaining ones have just received term sheets, again, at valuations that are perfectly normal in the sense of having seen no COVID impact. One other indicator is we had a company that had just started negotiations around a potential acquisition by a large corporation. And that one has continued. And so they're in late stage discussions now without that having gotten derailed. So I think as of today, I would say the impact has been nothing in terms of valuations and in terms of portfolio performance. I think we are still cautious about what might happen next year, but that's a different story. But so far, so good.
Neal, you get to see so many different CEOs manage their relationship with you as an investor. Did you see anything memorable that you'd say some really handled the situation well, the uncertainty and what happened at the beginning and what we've all now come through as we head into October? Is there anything you saw that you'd recommend to CEOs out there or to investors to look for in a CEO that you got to see during the pandemic?
Yeah, I think there were probably 2 key characteristics of the people who dealt with the pandemic successfully. I think one was they really spent a lot of time with their teams. So that it became a shared problem as opposed to just a CEO problem. And, all of our companies are creating products or services where the team members are highly motivated about what they're doing. So once it became a team issue, I think people came up with solutions that frankly blew my mind in terms of both the creativity and the resilience they displayed. And the flip side of that was that very frequent communications with the investors was also very helpful, as opposed to much bigger spaced out communications, a move to having much more frequent, weekly or every 2 weeks, little snippets of information and little snippets of communication, kept everyone aligned, kept everyone on the same page, and I think reduced kind of everyone's stress levels, so that people understood that this was actually something that was manageable. There were certainly some situations where hard decisions had to be made around furloughing certain people who simply couldn't come in to work on large pieces of equipment. But because that was done very openly and very transparently, I think it worked out well.
How about you, Dave?
To echo Neal's point, we encourage all of our CEOs and founders, to keep us constantly updated. And it's not enough for a CEO or a founder to say, "Oh, I'm so busy." It's just been a flood of demand that you can't find the 2-3 hours to put together kind of a good email or a good report to us as investor groups. So we really get on them for that. But for the most part, everybody's pretty much in line. If not monthly, at least quarterly. But we prefer monthly during these times and are willing to kind of accept quarterly when things stabilize. That's so important. And it's also, and those smart founders and CEOs know that you communicate and you don't sugarcoat anything. You say, hey, these are our needs. This is what we need help with. You'd be surprised. Many of our investors are connected here in the Pasadena, Los Angeles area. And we can find good people to help them out, or we can provide solutions to help them get through, the issues that they're having. So, gosh, a key element, I can't emphasize enough, the good communication CEOs and founders must have with their investors.
So it's one thing to communicate. I guess the other thing is what are you talking about? How did you find the quality of the reforecasting across your portfolio, Dave?
We have found it very real. We've asked a number of questions every time kind of a reforecast or a pivot has taken place, and it's important to identify areas where that can be pivoted to or where the challenges do exist. I mean, getting back to the My Lab Box example, there was a company that started out as just testing for sexually transmitted diseases, but this pandemic has opened up a whole new area, testing for influenza, testing for various other testosterone, male fertility, other areas that you wouldn't think of when it started going down this path, and now it's broadened itself out, and that's to everybody's benefit. So we make sure that they look at all their opportunities that perhaps COVID has kind of opened up for them, and some we don't agree with, but most we do. Most of our founders, thankfully, have good sense, and it's important to swim with your head above water to see all the opportunities out there.
So I look at this as a what doesn't kill you make you stronger kind of a moment. Did you, in that case, see that company did a reforecast and then got really pleasantly surprised, or were they not even able to predict what was going to happen? How was management's predictive ability under the circumstances? And then after you answer that, we'll ask Neal the same question.
In short, right away, not great. They couldn't predict. They were just taking orders in, and they were getting flooded with demand, because I think in March and April, when this was all coming down on us, no one could have predicted. No one could have predicted the results, flowing to them. However, after things stabilized, comes the summer months of June, July, they were able to offer a more comprehensive prediction as to what this next year and towards the end of 2021 would carry with proper ramping. I will say this, that because of the opportunity that was afforded them, and because of the increased demand, they were able to come to us, and we were able to provide them greater investment, a bridge loan to a discount on the future Series A that we were all happy, to get in on because we saw for ourselves the increased demand. So those CEOs and founders have to recognize the situation, have to recognize the opportunity, and then if more capital is required, come to us quickly, lay out that comprehensive forecast that they see that this opportunity has enabled them. And to their credit, they were able to do that pretty easily because we all saw for ourselves what lied ahead for us.
Neal, how was the caliber of communication you received from your portfolio companies, specifically on the issue of early stage reforecasting when the pandemic was first essentially declared and as it progressed?
Well, I think the communications were outstanding. I think the question of how good the forecasting was, is a different one. And that one was, I would say, hampered in the sense that in March, nobody knew what was happening with demand, with, macroeconomic demand, global demand. And so a reforecast was, kind of a best guess. And, people would do things like simply say, the reforecast is half of what we thought it was going to be. Okay. So it took our original plans and made it half. Okay. Now, and what that was really targeted to was to understand what the costs had to be brought down to in order to extend runway up to a certain point. And in general, what people were shooting for was to, especially for the companies that had recently raised money, to extend their runway to the end of 2021. And why 2021? I think there was a general belief or hope that by the second half of next year, we should be able to raise more money. And if we weren't, then everyone was going to be in kind of a pretty difficult situation, not just us. So we'd cross that bridge when we got to it. But I think the reforecasting was really done as a way to understand where costs needed to go. And as part of the reforecasting, there was also a very explicit understanding that this would be revisited, at the end of every quarter to understand how demand was playing out against what we had, quote unquote, reforecast. And so that's really the process that's been playing out. Now, what we're finding in some cases is in some of the enterprise-facing companies, well, it turns out that, in the summer and now in the third quarter, demand has actually come back more strongly than was originally expected. And so now the company has confidence to start adding more resources in and raising the burn rate over what had originally been planned. And yes, that will pull in the cash out date from end of 2021 to an earlier time. But there's a little more confidence now that the demand will justify the company being able to raise additional capital in the interim. So it's been very much a kind of a moving target. But I think the key in all of this has been flexibility and adaptability and being willing to either change things upwards or recognizing that if demand had actually played out the other way, we would have had to cut further. So that's been the nature of what we've been encouraging companies to do. I think we're fortunate in that we have very mature management teams in all of our companies. And so it's these are people who lived through 2008, 2009, and so they know what they're facing.
So sitting in your shoes in April 2020 with $250 million on the street spread across roughly 40 companies, what was your state of mind at that moment? And how do you now look back on that and think that maybe there are other things you could have done or that you're glad that you did do?
I think we're very glad that we encouraged all the companies to do this recasting of their plans. So zero regrets. I would just say, I think we're very thankful that things didn't turn out as badly as we thought they might. Now, we're not out of the woods by any stretch of the imagination. We do have two companies, for example, that will be out of cash sometime at the end of Q1 in 2021. They're going to have to raise money between now and that point. We'll have to see how that plays out. But the ones that, as I said, the ones that we were most concerned about were the ones that had just started their fundraising at the time. And the ones that are most immediate are always the ones that take up all your time and attention. And I said, we have been, I would say, extraordinarily pleasantly surprised by the fact that they have been able to complete actually very good financings.
So considering what you've just been through and the cautious, true caution with your yet optimistic view of the future, how's that impacting your willingness to go look at doing new deals and your pipeline and your approach?
I think that realistically speaking, the bar is higher. Every time we look at a new company, many companies that we might have been quite fine doing, let's say at the beginning of Fund 2, we'll now look at very, very carefully. Now, part of that is that, when you get to the last few deals in a fund, even under normal circumstances, the bar is always raised. Okay? Like, do we really need to add this particular company to the portfolio? There are other issues that come into play in terms of you're always looking at what the portfolio balance is. If you have too many companies in a certain space, you may not want to add another company, even if it's fine. So those kinds of issues come into play. I think the other thing that's played out in our particular case, which has nothing to do with COVID as such, is that as COVID hit, we had just started raising a growth fund, which I think you alluded to earlier. And this growth fund is designed, we call it the Bold Select Fund. It's designed specifically to invest in follow-on rounds of our most successful portfolio companies from both the Bold 1 and the Bold 2 portfolios. And by that, I mean companies where we may already have invested 6 or 7 million out of the original fund that the money came from. And just to remind you, we typically go in either at the seed stage or the Series A stage with anywhere between 150,000 to 3 million. And then we expect to follow on in those companies. But out of the core fund, we typically wouldn't allocate more than 3 to 7 million in a company. Now, if the company is continuing to grow, which now many of our companies are, we would like to participate in that growth, and that's what the Bold Select Fund is being raised for. We had just started that process in early this year in Q1, and we're about to do a first close in March. And as you can imagine, that first close got somewhat ran into a hiccup come March. And so that got delayed, and we ended up kind of re-engaging with all our investors in the June-July timeframe. And so right now, we're still very heavily involved in completing that fundraising. We have done a first close of that fund. We've made a first investment out of that fund. But because we're also very focused right now on raising money into our Select Fund, we just have less bandwidth to look at new deals for the Bold 2 portfolio. So I think because of that, we are probably going a little slower than we would normally. Some of that's because of COVID. Some of that is simply because we're also fundraising.
A question from one of the audience members, and I encourage everybody to use the Q&A button. If you've got questions, we will do our best to get to most of these questions, or at least a bulk of them, in the next half an hour as we continue the discussion. But this question talked about on your point, Neal, timeline, what do you think is the realistic time frame that a CEO and founder should anticipate to move from a first contact with a VC firm to get to the initial funding? And do you think that's changed since the pandemic?
So it depends dramatically on the stage of the company. If you are a growth stage company where you've got revenues that are meaningful and scaling, I think that timeline can be very short. So for example, we have a company that is now in the many tens of millions of dollars and scaling at about 100% a year. They began a fundraising process and were just overrun with investor interest. That's very different from a situation where you've got, let's say, a company that did a Series A, they've done some technology development, they don't have a product, they're now raising a Series B. Those kinds of situations take much longer, largely because they always take longer than the growth stage investments. Their metrics are much more difficult to evaluate. People really need to get into the technology, the markets, et cetera. So those kinds of things probably do take longer, and I think can take anywhere from, I think what we typically advise our various portfolio companies is to expect that fundraising can take anywhere from 4 to 7 months. And so when they're looking at their runways, they better start fundraising for their next rounds 9 months before they think they're going to run out of money. So.
And I know from my perspective as a lawyer that often is consulted to help young companies enter the fundraising process, we've spent sometimes 6 or 12 months literally with founders and the early stage group after a quick angel round of just trying to figure out, how to get them ready to present themselves, going over the deck, measurable amounts of times, and trying to flush out, all the issues that we know are certainly going to come up and create viscosity in the fundraising process. At any rate, Dave, how about you? Are you seeing, because I know you see a wide variety of pitches and a big pipeline at Pasadena Angels, are you seeing that process start to take longer now? Are you seeing reluctance on the part of your group to invest as rapidly as they have been in the past? What's your advice to the entrepreneurial companies that are looking for money from a group like yours?
We've been pretty much the same as pre-COVID. Typically, we're about 45 to 75 days. And really, I have to say on the pipeline, and this gets back to what you were talking about 5 minutes ago, typically we'll get about 16 to 20 submissions a month, of which we will end up investing on average about 1.5 to 2 companies per month. So we really put them through the rigmarole. That was pre-COVID. We still invest in the same amount of companies. Maybe two companies, one as an initial, one as a follow-on average per month. But the pipeline going in has been reduced maybe to about 10 to 12 companies coming in. So COVID has definitely scared off some startups from initializing. However, we've, like Neal was mentioning, we've definitely gone back to companies, and follow-on investment has been key, as we see that, again, I don't want to reiterate, but COVID acting as an accelerant to some of the businesses we've invested in previously, shortening their timeline to success and to growth. So we paid attention to that. So really no change on, actually, Zoom, I think everyone on this call would agree, has made us all more efficient. So instead of, showing up with bank statements and patents and so forth that our group might look at, we're able to do that electronically more. And although we do like the face-to-face, obviously that's off the table for right now. So it's made us all more efficient in our due diligence process. And we're not talking about the kind of money that VCs are talking about. So that timeline, again, I want to say 45 to 60 days for the most part. from inquiring to actually getting funding from us.
So efficiency is right on the mind of some of our audience members. One of the questions asks, do you see a more efficient way to raise capital as opposed to having to spend with your team 4 to 7 months distracted in fundraising to get to a Series A or a seed angel round? Neal, any better ideas about how a company can manage the distractions and be more efficient about the process?
I mean, it's a great question, and you know, I wish there were a simple and good answer to that. We haven't come across one, I think part of the reason is that, especially for the early stage companies, so we're talking about companies that, you know, don't have scaling revenues and all that. That's another ball game. But for the very early stage companies, this is very, very much like you know, it's a dating ritual in the sense that an early stage investor is going to be involved with a company for anywhere between, you know, 5 to 12 years. And so it takes a lot of time to decide if a particular team is something that you want to be spending the next 5 to 12 years on. And that just takes a lot of interaction. You know, we are human beings at the end of the day, and we're investing in human beings. And so getting to know the people is very important. That does become a little more difficult over Zoom. I mean, it's you know, we've been surprised by how much one can do, but it's not the same as being able to sit in an office with someone or sit at a restaurant and spend a few hours just understanding what makes them tick and what are their motivations. Because, you know, the plans that we see are fine. They're only starting points for the companies. We know that, you know, every plan is only as good as the paper is written on. And once you actually start engaging in what the company is trying to do, it's going to have to change. So at the end of the day, you're fundamentally betting on the ability of the team to make those adjustments as and when needed. And also the willingness of the team to interact with you to the extent that you're going to be, you know, involved in the company as a meaningful investor. There needs to be that two-way give and take. And it takes time to figure out if that is a dynamic that's going to work between you and the company or not. So we haven't found a you know, dramatically more efficient way to do that. And you know, I think the other thing to keep in mind is that for a startup, especially an early stage startup, it is not at all unusual to have to meet, you know, 40 or 50 investors before you find one who really latches on to what you're doing and likes the story and likes the chemistry. But you only need one, okay? You know, what we always try and remind entrepreneurs who complain about how much time they have to spend fundraising is that at the end of the day, CEOs, you know, when we look at a CEO's time allocation, let's say over a year or over any extended period of time, we say, you know, a third of it should be spent fundraising, a third of it with customers, and a third of it with your team. So to think of fundraising as something that isn't part of their job actually is just not the right way to think about it.
Well, and I think that kind of goes, in my experience, along with the idea of a company that's being built to scale because the demand is there, that they've found a sweet spot with their product, and obviously funding the growth of a company is what that's all about, and what makes you attractive, in my experience, to the kinds of investors that all three of us are, is when we see a company that the problem they're addressing is not trying to find the demand, but trying to figure out how to meet the demand. That's where we get excited, right? And so I encourage companies to do well at documenting that and to show that they've got a core competency in constantly going out to raise capital, whether it's from their own investor population, from their executives, from their founder, from VCs, vendors, suppliers, potential customers, strategic partners. I mean, when you're in that great spot of trying to build an entity that can scale to meet its demand, the world is at your doorstep.
Right.
And then it's just a question of what your core competency is to find the right investors that are going to be more than just the money, because sometimes I find that's the most important aspect. We have another
think
question.
That way. I was saying
Right,
not
right.
everyone thinks that way, but I mean, I think there are.
Well, and you made a comment about mature managers, mature C-level managers you were dealing with, and one of our audience members asked the question: do you see any difference as a result of having come through the pandemic with the demographics of those teams that you're looking at? Are they more seasoned, more mature? Are there other attributes that you think you would lean toward now, or that you're seeing in your pipeline that differ? Has the pandemic washed out some players, and now you've got a different caliber of companies that you're looking at? Dave, why don't you take that to start?
Sure. A good point, Michael. I think that the element and the characteristics of the founders we come across, we're definitely looking at more seasoned, because these will be difficult times, and folks who have been through, have been entrepreneurs in the past and have taken companies or built companies, that can be a great experience as well, have learned to allocate resources, to be flexible, where needed. And they're apt to do that more quickly and see those challenges ahead of them, because everything is moving much more quickly than it did pre-COVID. And those founders have to recognize that. I always use the analogy of, our economy or the startup world. It's like a snow globe. You turn it upside down and then back up, and the pile of snow is shifted over here. So those companies have to realize where their challenges now lie overnight. The new challenges, and where their opportunities lie. And because life has shifted, and experience is definitely getting more attention than before.
Neal, any difference you've seen in the groups that are now in your pipeline?
Not so much, and I think part of that is because we focus on companies that are either developing or using very deep tech, and often that requires a lot of experience. We don't have companies, that are of the form that someone coming straight out of college could do. They're not just based on, something that's being taught today in computer science programs, because enterprise apps require a lot more beyond that. The technology is a piece of it, but that technology is not a product. And so for the kinds of companies that we invest in, we've just found that teams with more experience just have a better chance of succeeding.
So thinking about what we've learned and where you guys sit now, looking at this post-pandemic world, hopefully post-pandemic world sooner than later, how's that impacted your due diligence, your view of due diligence and your process? Are there things you're going to expect and ask for that are different now than they would have been in the past? And your mere process of being able to go visit people, get on airplanes versus doing it over Zoom, how do you expect the substance and the process of your due diligence to now change going forward? Neal, let's start with you.
So that's a great question. We were fortunate in a funny way because, most of the Bold team is down in Santa Monica, but I've always been based in the Bay Area. So right from our very early days, we adopted Zoom to have our weekly meetings. So to start with. The other thing is that, while there is a developing startup ecosystem in the Los Angeles area, and we do have, a number of companies we've invested in coming out of Caltech and places like that. Most of our companies are not in LA. And so again, from early on, our initial interactions with those companies did involve a lot of Zoom or equivalent technologies. Now, what has changed is that before investing, we would actually meet the teams. They would fly out to LA, or some of us would fly out to where the company was, whether that was in Boston or Seattle or some other part of the country. That's obviously come to a complete standstill. Because we have been focused predominantly on the financings from our existing portfolio that were already in process, we have spent less time on brand new investments. But for the one company that we went through the entire process with and gave a term sheet to, I did finally break down and had a coffee meeting with the CEO. And that was actually my first face-to-face meeting with anyone post-March. And I felt that that was necessary before we could comfortably issue a term sheet.
But amazing, got all the way through the process predominantly on Zoom.
Yeah, absolutely. Zoom and, a lot of document review, data rooms, et cetera, et cetera. Right. But I think the quality of the data rooms, for example, has become much more important because you just have much less direct interaction with the people. So you end up relying more on indirect measures like, okay, well, how organized is their data room? Where are the documents? So I think being organized on the part of the startups is probably going to be more important because investors are going to have to rely more on those kinds of things than actually being able to go to the company's offices and have them show you things right there. So so presentation skills, being able to do demos, being able to record demos that investors can see, those kinds of things I think will become more important, and those are always good skills for people to have anyway. So it's been a good opportunity for them to develop those.
I kind of think that companies need to be more self-aware now that we've had this experience in the pandemic in terms of what they present to the investor population, specifically about how they dealt with the pandemic themselves, how their workforce dealt with it, what they really learned, how their reforecast taught them anything about their business that they didn't previously know, what pivot strengths they developed. It seems like there are a lot of really good stories to emerge from the pandemic. I know we had one client that had been working on a bricks and mortar transition to more clicks and mortar. They're in the retail lighting business. And as the pandemic ensued, they rolled out an appointment setting feature on their website because they could only have a certain number of people come in the store at a time. And they had delayed that for a couple of years, thinking it was of not much importance. And because of the pandemic, it suddenly not only got them lots of traffic coming into the store on appointment, but they saw that all of their shoppers online, a large percentage, started to want to use that appointment setting feature to come in and look for upgrades and have a personal relationship with a salesperson. And that company literally has seen their revenue shift from 20% online to 80% online during the course of the pandemic, and their top line revenue is higher in the last couple of months than it had been in any prior months. And so that was a fascinating lesson in how you pivot and what strengths you can now showcase as a result of going through this. And I've seen that in so many industries. Dave, do you have any other examples? I know you talked about the one where they saw that their product was their offering was conducive to people being at home. Any other companies that you've seen that have something now extraordinary to talk about if you were doing due diligence on them now that you'd want them to bring to the table?
Absolutely. I'll get to that in a second, but just to your point there, I think we can all see on our own communities, those restaurants that were set up with, a strong to-go service, are now benefiting from, increased orders when those mom and pop restaurants that just relied on, just folks coming in and sitting down that never really thought much about our hurting a bit. So, I mean, it's all around us, and those that had the infrastructure and set up and thinking ahead, those guys are pushing forward. Yes, another example I have with, well, first of all, I do want to mention, you had asked before about due diligence, and I think, on the angel side, first of all, our investments pre-COVID were about, I would say, about 60-65% initial investments and 35 to 40% follow-on investments. That has shifted. We're probably a little bit more than half of our revenues going towards those follow-on investments for the reason because we have those established relationships, and taking a chance on a new relationship without meeting them face to face probably does come into play. So it's shifted slightly, and I think that's a key reason. But getting to an example where this environment has really turned and put a spotlight on those companies that can accomplish better communication. We invested in early 2016 a company called Parent Square out of Santa Barbara, and really a terrific company. They provide kind of a communication tools between schools and parents. And whether it's admin staff or teachers themselves communicating with students or with parents or notifying them of a snow day or report cards, how it is one platform between schools and parents, and never has that been more important in these COVID times. And they were always gearing towards terrific growth, and they've got a great management team in place. But now more than ever, as a parent of two girls, and one in 4th grade and one in 6th grade, it's important to really be up to speed with how your kids are performing. And I think they now have about 15% of all schools in California, and are growing quickly in other states like Connecticut and Oregon and Washington. So it's terrific to see how what you were thinking about before and how the rest of the world is going to come around about utilizing your tool. COVID has now kind of put a spotlight on that, and consumers and school districts and so forth are now saying, boy, now it's more important than ever to communicate with these parents, and to keep, for private schools especially, how do we keep our students from going elsewhere? We need effective communication tools, and that has really put an emphasis on companies like Parent Square.
If I can jump in for a moment here, and maybe just put you on the spot, Michael, if you don't mind. I know folks will want to maybe email you, michael.platner@brisbois.com, and become a client for the real gloves-off advice. But what are you seeing, at the 50,000-foot perspective across VC firms, across startups, across the country? You're chair of this practice, co-chair of the Platner team practice, managing partner of your own office. You have a lot of partners and companies under you. Any other advice that you'd have for founders raising in this unique environment? Can folks hear?
Sorry,
okay?
I think I was on mute. Yeah, sorry, back.
There we go. Yeah.
I was saying that the cautious optimism that Dave and Neal talked about is what I'm seeing across the board. And I think that means that entrepreneurs need to be smart and patient and able to really explain themselves and think that things are going to take longer, not take less time to accomplish in terms of building a relationship, raising money. And I see a lot of the investors, focusing on their portfolio companies to make sure that they're okay and to make sure that they really understand what changes have occurred from the original business model now that we've been through this. So I'm suggesting that while there's optimism as to the future, that optimism I think is disproportionately applicable to the companies that have already gotten some level of funding versus those in this moment that are seeking funding for the first time. I think that we may be in a period where, at least for the next few quarters until things stabilize, it may be a little more difficult. But I think the key thing that can differentiate any company in this process is being able to be self-aware and explain what they're doing, why they're doing it, and how they've reacted, how their company has performed, what didn't kill them that made them stronger coming through this moment, why their offering is even more compelling now, if that's the truth. And if it's not, being self-aware enough to recognize that you need to get your team together and talk about these issues internally. And, you know, habit can be a good thing or a bad thing. If you've been in the habit of preparing to raise money before the pandemic and suddenly you're out raising money after the pandemic or in the ninth inning of the pandemic, and you're still doing it with the exact same pitch that you started with in January, I'm going to guess that you might be out of tune with where you need to be, unless you've really scrubbed that pretty hard. I want to ask the guys one more question before we terminate, though, which was asked by the audience, and I think it's a tough question, but it's a fair question to ask, and that is, how does the impending election also change your speed of action and your conservatism, and do you think that the election has any impact at all? And the question was asked directly. Do you look at it? Do you look at there being additional risk, or more risk, or less risk if Biden wins versus Trump? And so you can answer this question, Neal and Dave, however you feel most comfortable. But I choose to frame it in the context of this being an election year, just to add one more crazy aspect to all this that causes you to have a different view of what companies and investors should be thinking about right now. Dave?
Overall, I really think this is a great time for small caps and seed investment, because I just think the economy is just moving so quickly. As far as the effect of a Biden or a Trump continued presidency, you know, there are benefits to both. Obviously, I think Biden, you know, obviously new technologies and clean air technologies, I think would be, you know, more well received. That's not a surprise to anybody on this call. However, you know, Trump probably would keep down capital gains tax rates when Biden might raise them, forcing, you know, and putting people towards looking at startup investment as opposed to, you know, putting your money into the stock market. You know, I think one of the things we have to remember is we're competing against, you know, investors are looking at, myself included, and probably folks, do I put money into a Zoom or a Netflix, you know, some of these established companies, because they've had terrific returns, and, you know, or Spotify, you know, where it's quite obviously these mid-cap to large-cap stocks, you know, are really competing against the money that Neal is trying to garner from his investors, and even folks that are putting money into the Pasadena Angels in our fund. So we can't lose sight of that the economy is really moving rapidly, also on the big board and other places.
Yeah.
Neal?
So this is a personal perspective. I don't think Bold Capital has an official position on this. And I think that, you know, regardless of who wins the election, there will remain, I would say, incredible opportunities for startups, simply because technology is now enabling so many amazing solutions to problems that we all face. So we don't think that that's going to go away, and that's going to be driven by just an acceleration in technology and technology development. But that's a long-term perspective. You know, in the very short term, we are potentially worried about, well, I should say, worried about potential instability around the elections and for a few months following the elections. And so for companies that think they're going to be, you know, raising money in November and December, we're telling them to be maybe a little more realistic and either get it done before that or plan on the fundraising happening considerably after that. You know, the other places where there's an impact, of course, is depending on who wins the presidency, we are very concerned about how and where companies establish their supply chains. And the historic supply chains that are developed over the last 15, 20 years may not be that great going forward. So we do care about that. But I think, you know, at the end of the day, what we always tell people in this kind of unsure situation is listen, the most important thing for a startup is to not run out of money. And so take the money when it's offered and don't worry about valuation. This is not a time to be negotiating valuations. This is a time to be negotiating quantity of money, not the price.
Great advice from a seasoned investor, and thank you guys so much for everything. Thanks, audience, for allowing our firm your attention, and thanks, David, for bringing us the opportunity to sponsor this. I hope we get to do more in person with everybody. David, I'll turn it to you.
Wonderful. Well, thank you, Michael. Thank you, Dave. Thank you, Neal. Thank you to all of you for joining us in the audience. Wish we could all gather at the reception afterwards here, but we'll take a rain check on that. And in the meantime, just know, we're all rooting for you, all of you joining us. It's tough out there normally to be an entrepreneur, to be an executive at a company, but more exciting all the more here. And I think, we definitely know and when the road is tough, when the trail is tough, all the more important to have a good guide. So definitely, consider reaching out to Michael, learn more about how the firm can help your company in these unstable times. And, really just want you all to know here at TechFire, we're rooting for all of you. So thank you so much, Michael. Again, deepest thanks to Jennifer Roussillon, from the firm. True pleasure to work with you guys in planning this, and Neal and Dave, you guys have been wonderful. Thanks so much, all. And Michael, really appreciate moderating. Going to get down there in Florida and get on a cruise ASAP when this is over. Can't wait.
I'm spending all of January in Los Angeles. I look forward to seeing all you guys, hopefully. And thanks everybody for those questions that we didn't get to answer. Feel free to email any of us. I'm sure we'll be giving you thoughtful answers in return, and we appreciate your attendance. Thanks.
We look forward to the next event soon. Thanks, guys. Take care.
Okay.
Bye-bye.
Thanks, everyone.
Take care.
It's been a pleasure. Bye.
Thank you.